Welcome into the One Piece, folks. One video and one video only for me to react to in this one. Mr. Tom Lee is going to share his thoughts on what's going on in the market, what's going to transpire over this next few months, and I want to react to that, kind of give my opinions and perspectives. So I thought this was a 16-minute beast, so let's just attack this one here today and focus on this one video and one video only. So appreciate everybody joining me as always. Thank you so much for being here, folks. I just want to get straight into this, and also thank you for being subscribed. And by the way, if you want to follow me on IG, say hello to me on IG. That will be pinned comment down there. You can send me a DM. I get back to a ton of people each and every day. All right, guys, let's get into this.
And head of research. Welcome back. It's good to see you. It's been a while.
Yeah, great. Great to see you, Scott.
Now, I'm going to start calling you Prescient Tom. I hope you don't mind. Because this morning at 10:23 in the morning, you said possibly this is the flush. Bottom line, possibility equities reverse into the close. Well, it looks like you called it, Tom. What do you think about this reversal and what it means?
By the way, so, just right off the bat, this is fascinating. I was kind of reading through the comments in the video, and just so much, positivity certainly around Tom Lee, and just so many people, basically treating Tom Lee like he's a genius. And it's just so funny because the previous year, last year, obviously 2022, he was public enemy #1, and he doesn't know anything, and he's clueless, and he's just a permeable. So just it's fascinating in the market, like how fast people's opinion of somebody can change for the better or for the worse. It happens quick.
Well, I think if we think about the data for the past week, the stagflation story that gained a lot of prominence in the last 10 weeks, I think has diminished a lot because the jobs report showed good jobs, but soft on wages. We're making progress on the UAW strike. And then, of course, as you know, oil's come off that boil. And these are all pointing to an expansion that's not suffering from an acceleration of inflation. So I think it really helps the idea that, as you said, maybe the flush happened and we can be strong into year end.
Do you really think that this is that moment that turn is going to begin to happen, Tom?
Part of the tactical view comes from Mark Newton, but I think it was going to be either today or early next week because we had that intraday reading of the put call reach 1.97 only 20 times the last 30 years. It's so rare, but it has almost always signaled an imminent bottom. And then today, as you point out, we had a really high.
What he just said right there is so important for you guys. Especially if you're ever trying to figure out, when you're going through a rough market, are we near a bottom or something like that? Pay attention to put to call ratio. Pay attention to put to call ratio. When way too many people start buying puts, it's almost guaranteed you're within days, literally days, not weeks, not months, not years, within days of bottoming the market, at least for a short-term perspective, like for the next, month or so. Consistently, man, when everybody starts buying put options, holy smokes, it's a time to switch. The time to buy put options, if you want to get some put options, was certainly in the summertime, right? Get some put options in July, August on the market if you needed protection. Getting put options last week or something like that, you're just so late to the game. But man, it's just funny, everybody piles in, usually at the worst times possible.
Jobs number, a pretty big sell-off that is reversing in the face of people still saying nothing's gotten better. So I do think the sellers are exhausted and there's a lot of firepower on the sidelines. And if a few things go right, I think we get a big rally.
I know, but the one thing that's not really getting better, and I don't want to ignore it, rates are still high, right? So we were at 488 earlier today on the 10-year, so we're at 477. So we've come off, as you said, the boil, but we've still got a pot that's really simmering rapidly.
That's right. These are very tight financial conditions. It's probably not a long-term killer if we were at 5 for years, because we know 5% is the average for the 10-year for the last 90 years. But at the moment, that change has been very restrictive. If I was to be half full on this, we know this also means the Fed has less work to do, which means fewer hikes. So in some ways, as long as the market can absorb this change, and it's very restrictive, it's uncomfortable, I think that's positive. More importantly, as Walter Deemer pointed out, when you have a parabolic rise in rates, it's not going to take the escalator back down. If it does peak, it's going to be a sharp reversal, and then, of course, that's supportive for stocks.
Yeah. You think the Fed's done? Do you think Mary Daly was a pretty big tell yesterday in thinking that San Francisco Fed president, of course, thinking that the move that we've seen in interest rates has caused financial conditions to tighten substantially, in her mind, equal to at least one hike in rates, and that now that is the prevailing thought within the room, that credit conditions have tightened enough, we're restrictive, as you said, we're done?
Yes, I think the Fed feels that since September 20th, I think it was clear the market kind of got this new message, well, higher for longer. The market's priced it in. I don't know if the Fed has to keep jawboning it and even threaten further hikes if it's gotten to the place it wants to be. And as you're saying, when you have a Fed member saying it's a hike, another hike on top of that means that we're extra worried.
How about valuations?
Before we get into valuations here, okay, I think a huge component of, let's just call it, he was speaking about seller exhaustion. What's kind of another bull thesis for the market in the shorter term, okay? I'll put it to you like this, very simply, and I think this is massive. We are about to what? We are about to go into earnings season, okay? I don't know how many people feel comfortable continue to load up on short positions and put options knowing that we're about to go into earnings season. The bottom line is bank earnings start end of this upcoming week, right? And then we get the onslaught of earnings for the next 4 or 5 weeks there. Just crazy amount of earnings. Do you really want to go into earnings season super short the market, a ton of puts? I think earnings are going to be just fine. I think earnings are going to be just fine. I don't think we're going to have many disastrous reports. I think we're going to have a lot of encouraging words from companies, especially in regard to margins potentially improving, less inflationary pressure, right? And kind of more balanced business approach. And then you got big tech that we should see very strong earnings from Meta. The year-over-year growth in EPS should be outstanding for Meta. For Amazon, it should be off the charts in terms of their year-over-year net income growth. NVIDIA, same exact thing. So, and these are many of the most powerful stocks in the entire stock market. And we're going to set up for likely very good earnings for these companies. And so it's a tougher position to, continue to want to short and buy puts into an earnings season. Because when you're not in earnings season, the market can run with all this anxiety and fear about this and that and this. Oh my gosh, rates are going up. Oh my gosh, the Fed's going to do what? Oh my gosh, the oil price. It gets focused on everything that, is important stuff. But what actually drives the market over the long term? What has it always been and always will be? It's one thing. Earnings. Earnings is the only reason that the stock market is the value it is today, okay? There's no other reason for that. It is earnings. It always comes back to earnings. It always has and it always will. If company earnings are trash, the stock market's trash. If company earnings are great, stock market's great, okay? And over the short term, we can get worried about all this stuff, but you just got to understand the focus is about to go to earnings. And so that's not as scary, especially when you know earnings are likely going to be pretty good, and especially for many of the most powerful stocks. So this is just some food for thought there, right? Are Apple earnings going to be horrible? I don't know about that. And also, Tim Cook's always got a way to, make it sound pretty good.
Are you comfortable where they are and where, just simply relative to rates being high and, you still believe the economy to some degree is going to slow. It's just hanging in. So incredibly resilient. It's stunning. I don't know what else to say.
Yes, I know intuitively investors think PE has to come down because interest rates have gone up. But history shows when the 10-year is between 3.5% and 5.5%, the PE is averaged close to 20 times. Part of it is something that Sheila Bair had written about. It produces capital discipline. And that allows companies to have durable earnings, which means PE should be higher. But also, we're in an environment where nominal growth is higher, which means I also think we're in an EPS surprise environment. That's why PE should go up. It's really 16 times, actually less than that, ex-FANG. I think if it goes up four turns, that's a huge upside in equities.
Okay, I'm glad you went to earnings because I wanted to get there anyway. So you don't think that estimates which have crept up incrementally positive this quarter, a little bit more next, and then more substantially, obviously, as we get into 2024. You don't think those are, over their skis a little bit?
Earnings always have some risk because of optimism of analysts. So 70% of the times, earnings revisions are down. But the revisions to Q3 earnings are more consistent with a turn in the cycle. And we have to remember the headline earnings are still down year over year because of energy and basic materials. Without those, it's close to 7% earnings growth in third quarter. That's that's a really nice, companies are doing well. I think the greedflation is going to hurt, and of course we have some volatility.
Yeah, and the best part is we're about to go into the next 2 quarters specifically are going to be the strengthening in a major way. 3Q numbers when those come out, and then 4Q numbers. This quarter that's about to be reported, this isn't even the super exciting part. It's actually when you get 3Q numbers and 4Q numbers that I think things are going to be, much more interesting.
Right, but I think the overall picture is demand is holding up, and
Excuse me, Q4 and Q1. I think that's when you're really going to see some real acceleration. Q3 should be pretty respectable as well. No doubt about that. Q3 should be very respectable. I just think there's more excitement in Q4 and into Q1.
Costs are slowing. That should help be supportive of earnings, actually.
Yeah, I mean, you said, ex-FANG. So let's drill down on that a little bit more. What are we talking, 15 times for ex-FANG?
Just to be clear, because I know that was confusing. We're about to get the third quarter earnings. Okay, so all these companies that are about to report third quarter earnings, unless they have a weird fiscal year or something like that. But for the most part, the majority of these companies that are about to report are going to report their third quarter earnings.
Basically, the 490 whatever stocks within the S&P 500 versus the Megacaps. So if you think we're going to hang in there, and from an economic standpoint, and you think the Fed is done, and you think rates are not going to really, go much higher from here, do I want to start looking at ex-FANG, or do I want to just dance with the stocks that got me here to begin with?
Scott, I don't want to sound like I'm saying both, but when I think about how re-risk, like when institutions want to add risk in fourth quarter, they're going to buy what's liquid and what's worked. So I think that's why FANG should lead. But the reason the rest of the S&P is attractive is that you have a level set of 7% earnings yield, or maybe 6, but with earnings growth double digits. The total return profile of equities here trounces what you can earn on a 10-year. And I don't think investors are convinced of that today, but a year from now they will be. And that's why the S&P could have more than double-digit gains over the next 12 months.
I know, but you make a good argument, though, even as you argue.
So my perspective is, I think if you're asking me, like, what do I think does better into year end and what do I think does better likely in 2024? In my personal opinion, I think big tech does better for the remainder of this year. It's a lot of the, people playing the same story over and over again when it comes to this year. I have a very different view of next year. I do believe next year will be led by a lot of these dividend stocks and value stocks next year. Regardless if we go up in the market or down in the market, because there's certainly, 2 possibilities in regards to that, right? Regardless of market, I believe divs and values lead next year. That's my personal belief. We'll see if it happens, obviously, but just kind of looking at what's going on with valuations, looking at, if things continue to strengthen for a lot of the big techs, and looking at, obviously the continued selling pressure on those divs and values and the valuations those stocks are down to, the valuations that a lot of these big techs are starting to get to, especially if you were talking to they have another, 10% up move from here. Yeah, I feel pretty comfortable feeling that divs and values are more the play next year versus big tech.
Stocks relative to bonds, others would say, look how cheap bonds have gotten as rates have gone up. So there's still considerable competition in a really uncertain environment, whether it's cash equivalents or treasuries themselves that still offer a safer, let's just use that word, safer alternative.
Yes. I think it's correct for people to have that view. How many additional make that decision in the next 12 months, I think, is what matters. We already have seen trillions flee out of risk assets. The stock market has been starved of retail and institutional equity flows. The movements have all been just prime brokerage leverage. Buybacks will continue. I think on the margin, if inflation is diminishing next year and people think the Fed is done or might cut, that's good because bonds could rally. But as we know, if that happens, we know PE is going to go up a lot, so stocks will rally even more.
Let's bring in CNBC contributor Bryn Talkington of Requisite Capital. Tom's just going to join the conversation. So, Bryn, I believe you heard everything that Tom had to say. Do you agree?
Well, I think that going back to the technicals, let's just go back there. I think that we started the week with...
So whenever somebody basically starts out by saying, well, blah, 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 and they don't say well, I do agree with a lot of what they say, or I do agree, usually they disagree.
With only about 15 stocks above their 50-day moving average, when it gets below 20%, that's really bullish from a short-term bottom. That was right on top of the S&P, almost getting to 4,200. So I think we were in this really oversold conditions. And I think, great job on Tom calling for a midday rally. And so I think we can definitely rally from here. Don't forget Monday, the bond market's closed. So this party can continue because there's nothing to stop it, because really this has been a rate-driven market. So I think that's going to help. I do think, though, over the next few months, outside of seasonality, which is a real thing, right? I would never discount it. I think over the next 6 months, though, we're going to be much more range-bound between this, let's say 4,200 to like 45, 4,600, because I still think there are so many cross currents. I think on the earnings.
Whoa. Hold your flip and flapjack and horsies for just a moment. She said over the next 6 months, we're going to be range bound 4,200 to 45, 4,600. Wait just a moment. Basically, you're saying you're very bullish on this next 6 months, because let's be honest, the S&P 500 is 4,300 today. So you're saying there's very limited downside this next 6 months for the S&P 500. But, if you talk about S&P, especially 4,600, that's quite a bit of upside from here, folks. You're talking about, those big tech stocks we were talking about. If we go to 4,600 on this S&P, almost all those big techs are going to be at new all-time highs. You're talking about NVIDIA pushing 600. You're talking about Meta pushing 400. You're talking about Amazon pushing probably 160, 170. You're talking about AMD pushing 140, 150, if not higher than that. You're talking about Apple pushing over 200. You're talking about Mr. Softy, maybe approaching 400. I don't know. So all I'm saying is yeah, if we go 4,600 in the next 6 months in SP 500, I don't call that range bound. I call that, damn, that's going to be some money made there.
Though, if you look at Goldman Sachs, I think Costin does good research. Technology is where you're going to get all of the earnings growth next year. So they're looking for 10% earnings growth, year over year from 23 to 24. And so we're going to have to get that, because those stocks are more rich. And so I am not in the consensus that I think we're going to have this 12% earnings growth. And so when I break down the names, I do think you still want to own technology. But within technology...
So let me be very clear. What you just said there, where you're going to get the earnings growth in technology, that might be for the overall market. But let me be very clear. I believe you're going to see a lot of these dividend value stocks have actually much more incredible earnings performance in terms of the rates of growth in 2024 versus a big tech. Because let's not forget, big tech was faster to adjust to the new environment of higher interest rates, of the consumer, all those sorts of things, than let's call it a lot of the dividend value stocks were. A lot of the dividend value stocks have been putting in restructuring plans this year and over the past quarter or two, right? And all these cost savings initiatives and all these sorts of things, right? Prioritizing, how much they actually want to hire versus not hire. All that's been happening really this year. And so those companies are kind of going through their messy year this year, like big tech did last year. So I'm not saying big tech's going to necessarily have a bad year next year. It's just you're going to see, I'm telling you, a lot of these dividend and value stocks go up 30, 40, 50, some much more than that next year, as long as the market's just decent. Outside of a super big market crash, you're going to see some incredible performance from some of those stocks that are sleepy stocks, because all this work they've been doing behind the scenes is going to come to fruition next year, and it's going to start paying off and paying dividends, no pun intended, in regards to that, right? So big tech just got out in front of everybody. Big tech's always going to be the smartest ones in the room, so they're always going to make their adjustments faster and before the rest of the businesses and companies make their adjustments, right? That's why they're $1 trillion market caps instead of $1 billion market caps, right?
Have to be, somewhat judicious, because while, if you look right now, Scott, Microsoft and Apple's charts look terrible. Their revenue and earnings growth haven't been as good as, let's say, a Google and Microsoft. A Google and Meta, whose charts look really strong and continue to gain momentum. So it'll be interesting to see if we start getting some dispersion of those mega cap names, especially as earnings come out next quarter. We'll see, but I think that's a pretty decent probability. Some dispersion of the mega caps starts to play out.
I feel like, Tom, that's a long way of saying that. I'm not necessarily as optimistic as you are, Tom, that earnings are going to reach the level that some, like Goldman and others, suggest that they might. Now, they might in Megacaps. That jury's still out, but certainly not elsewhere. So, Tom, how do you respond to that?
Well, I mean, I think there is a pretty long list of worries out there. Because, if I were to add to Bryn's concerns, I would add China and Europe and the war and the escalation of the Ukraine war.
And now the new conflict we got on our hands, holy smokers, this is never any jokers. There's always stuff coming out of nowhere, folks, always.
This environment, which has been incredibly challenging for companies, they're able to produce 7% earnings growth now in the face of the Fed relentlessly raising rates. But in the next 12 months, they're taking their foot off that. Oil, I think, might have made a local top. Wage pressures went from, nearly 6% on their way to 3.5%. And a 10-year environment like this with nominal GDP does point to very good earnings growth historically, and the PMIs have convincingly bottomed. The ISM was stuck below 46 for several months, now back to 49. So to me, it's pointing to an economic momentum that's materially improving. So I think that rate of change is what's going to compel stocks to get PE expansion.
Tom, what do you make of weakness that we've seen in utilities and staples and transports and things like that? Are they any bit attractive? I know that all of these other sectors, the lights on the marquee, they're the ones that are there. I get it, but sometimes you see the best opportunities where the greatest amount of carnage lies within the market. Utilities, staples, things like that. Are they attractive to you or not?
Yeah, utilities. Look, for someone who's really great with timing, utilities, risk adjusted, probably are huge opportunities. I mean, I bet you it's going to follow TLT, right? TLT at some point is going to make a pretty tremendous upside move if Mark Newton's right, and the 10-year goes back towards 4% next year. And on transports, it's tricky because you've got to pay attention to what's happening there, but there are a lot of interplay dynamics that are...
You know what worries me in regards to this whole situation, folks? I got to be honest, okay? Because the TLT does look like it's a freaking firecracker getting ready to take off, okay? But the thing that worries me, and this is a huge concern for me, is everybody's freaking talking about TLT. Everybody's talking about it. Everybody's thinking it's about to be the play. I get worried when like everybody's talking about it. Everybody's looking at this thing. Everybody's keeping an eye on TLT. I don't know, man. That worries me, and that almost makes me say there's got to be something else. Maybe, just maybe, TLT's not coming back anytime soon. I don't know, man. Like that's something that actually concerns me.
Syncretic and not necessarily simple macro. And then staples, I mean, it's tough because, that's a greedflation sector, and now it's on the margin some strange stories about, calorie consumption could be declining. I mean, it's tough. I think I'd rather own technology stocks over staples because at least technology stocks you don't have to worry about calories.
Yeah. I mean, I don't know that you'd find too many people fighting you on the idea of owning technology stocks over staples, so I don't know if that's necessarily a fair fight. But Bryn, how would you address those two sectors or just simply other areas of the market that might work outside of big tech?
So I think going back to utilities and staples, we were looking, if you look at the net debt to equity of every sector in the S&P, which three sectors have the highest debt to equity ratios? Utilities, real estate, and staples. And so I think that those three areas, and so we're talking about two of them, are just much more susceptible to the D of the D and the E, right?
That's
to rate
point.
Rises. So
Fair.
I think this is
Fair.
a unique time, typically later stage in the economic cycle, those would be doing well. We have a whole new playbook. I think that people can count on large cap technology to know what you're going to get. You might not get great revenue growth, but you're going to get good earnings because they're all buying back their shares. I think from an allocation perspective, what my concerns are is that I agree with Tom that the economy is probably going to stay really strong, but for the wrong reasons, because it's government led. Because don't forget, we had the 1.9 trillion American Rescue Act, and then three other ones underneath them. Those dollars, Scott, need to be spent. There's billions and billions of dollars that need to be spent by 2025. And so you're going to continue to see municipalities doing very, very large infrastructure plans. And so bottom line what does that mean? That's good for the economy, but what else is that? It's inflationary. And so I just think we're in times where the government is spending like they're trying to get out of a recession, and they're doing this pre-recession. And to me, that ends up causing just the higher probability that recession stays stickier because of government-induced programs into the U.S. And so to me, that puts somewhat of a ceiling on rates as well as markets, because we're going to continue to be having this inflationary conversation. We're not getting to 2% anytime soon.
Well, we seem to be...
Okay, you had me up till that. I don't know about the whole we're not getting to 2% anytime soon. I don't know about that.
March there, Tom, I think you'd probably disagree.
Yes, I mean, to the extent that I don't think it's a fait accompli that inflation is going to be accelerating or sticky. I mean, as we know, the only sticky part of core inflation right now is shelter, and housing is going to get walloped as mortgage rates stay here at 8. So to an extent, this rising rates is accomplishing what the Fed wants to do, which is kind of put a ceiling on home prices for now. And that's going to really restrict CPI. I mean, 40% of core CPI is basically housing related anyways.
Thank you, Tom.
Autos, that makes it close to 57%. So as long as cars and housing aren't accelerating, inflation is on a glide path lower.
Tom, what's your target for the end of the year for the S&P? You still have one, correct?
Yes. Scott, I think we're going to rally double digits, so I think we're going to get over 4,800 by year end. I mean, a lot has to go right, and I'll tell you, there's a lot of damage in the last few weeks, so, you know, it may not get to 48, but I think directionally is the correct that I think...
Oh my gosh, man said 4,800 by year end? You would be flipping my flapjacks. We're at 4,300, folks. Oh my, I mean... Jeez, I'm not going to hold my breath on that one, but could you imagine the move? Talk about making some money. Wow.
Have a very strong reflexive recovery because interest rates...
I was thinking he was going to say like 4,650 by year end, which is still a huge upside, but 4,800, what?
Nearing an end of a parabolic rise.
Wow. Well, we'll see for sure, and we'll talk to you plenty.
Even Scott was like, wow, okay, that's quite a number there. Oh my gosh, okay. Folks, I appreciate you joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel. Hope you enjoyed today's video. Also, if you want to say hello to me on IG. My Instagram will be the pinned comment down there. You can follow me. I'm always posting a lot of Instagram stories on there as well. Much love and have a great day.